Good morning and welcome to the Killik and Go podcast for the 2nd of October. One key number encapsulates the market this week, and it's the US ISM number. This came in sort of slightly below expectations at around 50, but if you look down, drill down into the detail, we saw weak export orders due to the strong dollar, weak global growth, weakness in energy investment, and an inventory overhang. And the overall mood described from the survey was mixed, with some concern about the global economy and consumer confidence. So this mood is infected markets, and we've seen weak markets over the last couple of weeks, and you know, our concerns at the moment is whether we see further infection in terms of management guidance going into the Q3 results. So we'll talk a little bit about that in due course. So connected to this, we've seen a really big deterioration in market sentiment. So the put-call ratio, which is simply a sort of hedging mechanism for investors, is at its highest level since September 2011 and August 2007. But also this week we've been seeing good numbers from domestic consumer for one. So the Italian consumers' confidence is back to 2002 high. We also had the Tankan survey in Japan, which is a business confidence number, and again that's the highest level we've seen since 2002. So it's a mixed picture out there, and we've been talking about that for a number of weeks. Woolsey probably was a good example of that sort of dichotomy in terms of performance. So we like this business because it's connected to the domestic consumer in the States and the UK. But they came out with numbers that hit expectations, but they downgraded forward guidance marginally from a like-for-like growth of 6% to 4%. And this is because they were seeing less industrial activity, so connected to that oil and gas investment that we're seeing in the ISM survey. And that sort of allowed them to be more cautious about the first half of 2016. So as a result, the market duly sold the stock off quite aggressively on the announcement. So that was down 13% on their numbers. We feel that presented a really good buying opportunity because it was simply a cautious outlook statement. It wasn't anything in terms of a deterioration in the business. And we feel we'll see a stronger impulse in terms of the strong dollar and domestic recovery coming through in 2016. And within a few months we'll be looking at a better situation. So the market started to sort of correct that initial reaction. We started to see that rally, but it was a good instructive precursor for probably the Q3s coming up. We've got to watch for that sort of issues of oil exposure essentially in stocks that might not be so obvious. We issued 2 buy notes this week. The first one was in Continental, which is the European tyre manufacturer. We like this stock because it's actually a very cheap structural growth story. So they have 25% of the exhaust emissions market and 25% of the vehicle automation market. So these 2 markets we think are very big markets for the future. And they're being driven by some fairly aggressive legislation coming out of the EU in terms of emission reduction targets and the adoption of advanced safety content. So what we mean by that is automatic braking systems, cameras, sort of lane detection systems, etc. This business is trading on 12.5 times earnings, which is reflects the sort of deeply cyclical nature of the autos industry. But we think that growth rate that we're seeing at the moment, which is low double digit, is more assured than the cyclicality that the multiple would reflect. Because we see this legislation only growing, and as it accelerates, we think that earnings number can accelerate as well. So that was issued this week. We've also issued a buy note on Deutsche Telekom. So this is simply about the European telecoms market. So it's highly fragmented with over 25 major telecoms providers in Europe. And the EU's 2020 digital agenda is suggesting a shift away from prioritising price reductions for consumers to actually allowing these telecom business to charge a fair price so that they can invest in the infrastructure within the sector. that's starting to happen. We're starting to see consolidation in the sector, and we think that will only continue and allow the average margin of the European telecoms companies to get nearer to where the US is, which only has 5 major telecom providers. So it's a very concentrated market in the US. So the other sort of very strong drivers for this story are data usage, which is accelerating. So 4.5G networks are now more prevalent. We're seeing larger screens, encouraging more mobile browsing. And therefore, average revenues are inflecting per user. After many, many years of voice revenues declining, they're now being replaced by data revenues. So we're seeing that inflection point in the average revenue per user. Given the high operational and financial gearing that you see in the telecoms businesses, that has a very big magnified effect on the earnings per share. And we think that can drive a big re-rating in the sector. And as you can see here, this is a very long-term chart. We've seen a very flat performance from the sector over the last couple of decades. The further thing is that they own 60% of T-Mobile, which is one of the 4 US players, and their likely target, in our view, from someone like Dish, who has a lot of spectrum, but not enough subscribers to put on that spectrum. So week ahead, we have got Pepsi and Yum Brands on Tuesday. We've got Tesco's on Wednesday, and Samsung Electronics. Then Thursday we've got Alcoa, so that's the first big US reporting company. So that kicks off their results season, Q3s, where we'll have a little bit more to say about the companies. Just talking about Tesco briefly, we saw a really good reaction to Sainsbury's share price earnings beat this week. We feel probably the quality of the beat was questionable. It came through petrol margins, non-food, and falling interest costs. So we're still seeing that depreciation or deflation in UK food prices, which is affecting these businesses. So perhaps too early to call on Tesco's, but obviously these stocks are cheap. We're seeing some sort of stabilisation. Thanks very much. Have a good weekend.